So I don't think I really need to tell you what is a budget, huh? Hope you guys have all got your budget sorted, huh? I'm sure you have. Do they balance, huh? Or do you run out of your budget? A budget shows you exactly where your money goes and provides a spending plan that lets you save for the things that are important to you. A personal budget is a finance plan that allocates future personal income towards expenses, savings, and debt repayments. Past spending and personal debt are considered when creating a personal budget. A national budget is an annual plan which shows how much money government thinks it will receive in the next year and what will spend that money on. This shows that the budget has two sides, namely the revenue and expenditure sides. There's generally in concepts there's no difference, only the way that it's been managed and the things that are considered becomes a little bit more complicated than a personal budget. Advantages of a budget. A budget is a guide that tells you whether you're going in the right direction you want to be headed in financially. A budget lets you control your money instead of your money controlling you. A budget will tell you if you're living within your means. Before the widespread use of credit cards, you could tell if you were living within your means because you had money left over after paying your bills. The use of credit cards has made this much less obvious. A budget can help you meet your savings goals. It includes ways for setting aside money for savings and investments. Following a realistic budget frees up spare cash so you can use your money on the things that really matter to you, instead of wasting it away on things you don't even remember. A budget actually creates extra money for you to use on things that matter to you. A budget helps your entire family focus on common goals. A budget helps you prepare for emergencies of large or unanticipated expenses that might otherwise knock you for a loop. A budget reveals areas where you are spending too much money so you can refocus on your most important goals. A budget can keep you out of debt or help you get out of debt. So it helps you sleep better at night because you don't lie awake worrying about how you're going to pay or make ends meet. A budget consists of the following elements: an income, which represents the source of the revenue, where the money comes from, and the expenses, which represents the items money is spent on. There are two types of expenses. We get fixed expenses and variable expenses. Fixed expenses are those that we need to pay the same every single month, like our rent, car repayments, insurance premiums, bank charges, all that sort of stuff. Then we get various expenses, which is our telephone account, groceries, money we spend on entertainment, all that sort of thing. The example budget on the screen just shows a template of what your budget could actually look like. When developing your budget, list the income, all those income sources as I've just mentioned, and then list all your expenses. Now, the difference comes in here is when you're looking at your expenses, you need to go and analyze them and assess your expenses in terms of investments, in terms of savings, in terms of groceries. Are things necessary? Aren't they necessary? Because sometimes we also just tend to write down our income and write down whatever we need, and that whatever we need could be exactly the same as what we buy every month. We have to go and evaluate that and also start looking at whether something is really needed or whether it's not needed anymore. Otherwise, we're becoming into a habit of just buying things out of habit rather than out of necessity. Now we all know banking, huh? Which bank are you guys with? I'm sure you're maybe with Capitec or ABSA. Maybe even First National Bank or Standard Bank or Bidvest. I see my bank's not listed there. Huh? Nedbank is my bank. Banking is a very important service in today's world. Most people can't even earn a salary without a bank account because employers insist on paying salaries directly into the bank account. Or generally anything you do today, you can't do without a bank account. When you borrow money from the bank, you'll be charged interest on the amount. Likewise, If you invest money, you'll earn interest on the money. There are several types of interest, and we'll explore simple and compound interest. Interest is the fee paid on borrowed assets. It's the price paid for the use of the borrowed money or the money earned by deposited funds. Now, even if you invest money, that means that that person that's investing it from you, they then are borrowing the money from you, and that's why you're also receiving interest. All right, so let's take a look at simple interest. Simple interest is only paid on the initial capital investment over the total period of time. In other words, the amount of the money invested remains the same and you will be paid the same interest. If we take a look at our example at the bottom there, we can see that the interest paid on a simple interest is 100 Rand every month. Even though my amount column is going up, I still only pay 100 Rand. Now on compound interest will vary and it's compounded based on previous interest as well. So you're generally paying interest on top of interest. Let's take a look at some examples. So to calculate simple interest, we use the standard formula. Principal, so our principal amount multiplied by the rate, so that's the interest rate that we get given, and multiplied by the time frame, so how long are we going to pay the money back over, or how long did we invest it for. So we take our principal amount. Let's say Peter buys furniture for 9,250 Rand and he buys a car for 2,500 Rand, and please tell me where he bought that car for 2,500 Rand. I'd like to know. But okay, just an example. So we add the two values together. The total amount becomes 11,750 Rand. So that is the initial or the principal value. So let's say the bank gives him an interest rate of 12% and the time is over 4 years. So it's 11,750 Rand multiplied by 0.12 because obviously we have to convert the percentage back to be able to calculate it. Then we multiply by 4 years, and that gives us 5,640 Rand, and that is the total amount interest that he'll be paying back or that he owes for the money borrowed. Now, the formula for compound interest looks a little bit different in that it actually calculates the total amount that you will have to pay back, or the investment amount that you have over a specific period of time. So hence you'd need to deduct or subtract the initial principal value. So our formula looks as follows. It's the principal value, or 1 plus the rate to the power of n being the time frame. So that then becomes the total amount of money that we owe, and then we just subtract the initial amount or principal amount to get the interest that's owed. So let's say the same scenario. Peter buys his car for 2,500 and he buys furniture for 9,250. That is 11,750. So we take 11,750, which is our principal amount. We take 1 plus 0.12. Remember board mass. So we first calculate the 1 plus 0.12 to the power of 4. And that will give us a value, or then we multiply it by the 11,750. And that gives us a value of 18,488.85 cents. We minus then the principal value, and that gives us an interest of 6,738 Rand and 85 cents. Now, if you remember in the previous example with simple interest, it only calculated to 5,460 or something like that. So you can see how damaging compound interest is. Now, compound interest is generally given when people owe the banks money or when you borrow money. When you invest money, you only get simple interest. So let's take a look at inflation. Each year, money loses value and you buy less. The decline in this value of money from one year to the next is called inflation. As inflation rises, the purchasing power of the rand, and therefore your purchasing power decreases. We're going to take a look at nominal rates, commission, depreciation, and appreciation. So to calculate inflation, or to be able to see the percentage of inflation, we use the following formula. And inflation is the last year's price of goods compared to the current price of goods. So whatever you bought something for last year and whatever you're buying it for now, that becomes the difference between those two, becomes the inflation rate. And this we calculate using the Consumer Price Index, the CPI. And the calculation for that is the change in the index. So in other words, the difference between the two prices. Last year we paid $39.95 for a McDonald's burger, and this year we paid $49.95 for the same combo. And the difference there is then 10. So it's then 10 divided by the initial value multiplied by 100, and that gives me 25%. Now, when we're buying and selling goods, this becomes very difficult. It becomes difficult for us to be able to manage, and this is why we're struggling. However, that's why your budget becomes very important, because you need to go and have a look at those expenses and adjust consistently. Now, interest rates are influenced by the supply and demand of money. So we were talking about interest a little bit earlier, compound and simple interest as well. And this is also affected here because the amount of money that the bank takes off of your money in a month, or the amount of money that you have in the bank, also earns interest. So this is the increasing amount of money that available tends to lower the purchasing power of the currency because it causes inflation. So what generally happens is when we talk about supply and demand we'll discuss in a lot more detail in cluster 9, but it's about the supplying of goods and the wanting of goods by customers. All right, so hence we calculate this to calculate the real interest rate, we take our nominal rate, and the nominal rate we minus the rate of inflation. Okay, so the nominal rate is what we think it's going to be. That's the interest rates on loans and things like that. That's the standard rate, generally, what we think it's going to be. And we minus then the rate of inflation, and that then gives us the real interest rate. Commission is a fee or allowance given to a salesperson, partner, estate agent, stockbroker, or other person in exchange for services rendered. Commission is often calculated on the basis of the percentage of the goods that's sold. So a typical example would be an estate agent. They sell a house for 4.4 million and they get 2.5% commission on that sale price, which gives them 110,000. Okay, you may work on a commission basis as well, and you maybe get a basic salary of 2,000 Rand a month. And for all the goods you sell, you then get 10% on those goods. You've probably also walked into a retail store and the sales guys have been right on top of you to help you. That is because they're probably also earning commission. So the more they sell, the more they earn. Appreciation is the term given to the increase of value of assets, big assets like houses, factories, buildings, all those sorts of things will actually appreciate in value rather than depreciate, which we're going to have a look at now. If you buy property today, in a 10, 15 years time, the value has actually gone up. So you may have bought it today for R1 million. In 10 years time, you'll probably sell it for 1.2 million or 1.4 million because it actually increases in value depending on the demand or the supply of property. Depreciation, on the other hand, is the loss of value of assets. So you'll probably find in your organization when they buy furniture, computers, vehicles, all that sort of stuff loses value. So they'll calculate that on an annual basis, and they'll also calculate what it will cost the organization to replace those goods over a time span. So for 10 years or 15 years, a lot of organizations, I saw them now at year end, they're replacing a lot of furniture because the furniture has obviously reached its end date or its expiry date, and it needs to be replaced according to company policy and procedure. Now, to calculate depreciation, we use the same formula as for compound interest. The only difference there is in the brackets, it becomes a minus. We don't add 1 to the rate. We now subtract the rate from 1. Investments are sums of money that are put away where it can make more money and grow over time. Annuities, bank accounts, fixed deposits, things like that. In return for a lump sum, the life assurer guarantees to pay you a regular income of a fixed amount or increasing each year. The income you receive is determined when you buy the annuity and depends largely on prevailing interest rates and your life expectancy or the term. Now, you can see that all of these things are integrated into each other, because if you have an annuity, you get interests, so you have to understand interests. That annuity appreciates over time because it increases in value. If you bought a car, you know that it depreciates. So they all have a lot of things to do with each other, and they all interlink to form this entire circle of business and also in life. Budgets are essential in financial planning, whether personal and/or government. Banks ensure the safekeeping of your money, and bank accounts are an essential part of living today. When investing and/or lending money, you are charged either simple or compound interest on the goods purchased on credit. Commission is monies earned for service delivered in percentage. Depreciation and appreciation are terms given to either the loss and/or increase of value of assets. Investments are monies put away to grow over a period of time.